Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
This episode is sponsored by our friends at White Charts. If you're an advisor, you know one of the hardest parts of building a proposal is turning client risk tolerance into an actual investment plan that they can understand and trust. That's why White Charts launched Risk Profiles, a new way to align your client's risk preferences directly to your investment recommendations without the guesswork. Risk Profiles bring structure and clarity to your proposals, helping you map models to risk levels with a customizable, repeatable framework, whether you're using White Chart's public templates or embedding your own firm's methodology. Best part, it's easy to show clients exactly how a portfolio fits their risk level with intuitive visuals that make the why behind your recommendation crystal clear. Whether you're personalizing one-on-one or scaling across a team, Risk Profiles help you deliver proposals that are consistent, transparent, and easy for clients to trust. Click on the link in the show notes to learn more about Risk Profiles and get 20% off your initial White Charts professional subscription when you start your free White Charts trial and tell them that Meb sent you. New customers only. Welcome back, everybody. We got the perfect guest today to talk about what's going on in our crazy world. Today's guest is Philipp Carlsson, the chief economist at BCG, where he advises execs, investors on the economic outlook. He was previously the chief economist at Sanford Bernstein. He published a book last summer called Shocks, Crisis, False Alarms, How to Assess True Macroeconomic Risk, which I got to be honest is one of the better books I've read in a while. Everyone in the office has been raving about it. Philipp, welcome to the show.
Thank you for having me. It's a pleasure.
Let's kick it off with a quote. This is one of yours, and I feel like we can just use it as a jumping off point. But you say, we recommend 3 habits. Reject the master model mentality, resist doomsaying, and integrate insights from various disciplines. What do you mean by that?
Let's start at the beginning. Master model mentality is a shorthand we use in the book to describe the idea that economic models are going to give you accurate forecasts or anything you can hold on to. In reality, economics isn't constructed like a natural science. It doesn't have the persistence and constant nature of physical science variables. It doesn't have the capacity to make precise forecasts. And so whenever we talk about forecasts, we should remind ourselves of the master model mentality that we naturally all succumb to here and there and take a pass most of the times, all of the times. And then avoid doomsaying as a reference to the nature of our public discourse. The way economics is covered in the media is based on a clickbait business model. Doomsaying sells. And so you rarely get balanced or insightful debates in the headlines. You mostly get stories that are, tuned to the downside to make us read them. And so generally speaking, there's good journalism out there for sure, but even in the quality papers, you'll see that slant to the downside. Just think about the inevitable recession of the last few years that never arrived would be sort of exhibit A of that theme. And then the last point that we like to stress, and the book is certainly full of it, is what we call economic eclecticism. Eclecticism, just a fancy word for many different disciplines pulled together. There isn't a pure play macro method that we think works. Economics, again, is not a natural science. Economics is closer to the social sciences than the natural sciences. And I think we do best when we borrow liberally from adjacent disciplines. History, finance, further afield, even if you want, into sociology and other disciplines, where you can string together narratives that fall outside narrow models. So long answer to a good question, but those 3 things are the shorthand in the book for how can we do better than model-based forecasting.
The doomsaying is so seductive. And part of it, look, you go on TV, they want to hear their ideal guest is someone who's hugely convicted, hopefully non-consensus, that's even better. But their view is this is going to happen. It's boring for someone like myself to go on there as somewhat of a quant and say, there's a spectrum of future possibilities. This may happen, it may not. Like, no one wants to hear that, right? They want to hear this is the next Great Depression. These things are going to cause stocks to go down 90%. Or, hey, it's time to buy, load up the truck. Bitcoin's going to be $1 million. That's what get the headlines. And 12 months later, most people forgot which way you said or even what you said. So
that's right. And public discourse is very forgiving of false alarms and those who claim disaster and then it doesn't happen. I mean, it's almost like some of the chief doomsayers is almost like a broken clock. You're right twice a day. So if you just tell a doomsaying story consistently, eventually you'll strike gold. And that's when public discourse kind of celebrates the doomsayers and says, see, they told you. In reality, over the long run, macro is a little more resilient than the doomsaying discourse wants you to believe. Not saying that there are any risks, particularly right now as we're going through the tariff gyrations. There's certainly plenty of cyclical risk, even structural risks, which are two very different things, right? But even so, I think we need to steer clear of the default assumption that calamity and doom is upon us. The world's a little...
It's tempting even from our standpoint too, though. I think all us humans love to pat ourselves on our back. And anytime we make some prognostication and become right, it's a great feeling because not only were you right, but also you can look around to all your friends and colleagues and say, I told you so, right? That's such a natural feeling that all of us, we say lauded, I predicted the future, particularly if it's bad, because that feels like an extra gold star you get if you predict something really horrible. Well, so when you say the word economist, I think it means a lot of different things to a lot of people. When, said to you, what's like kind of your framework when you're looking at the world, when you're looking at macro? Is there a way to kind of summarize how Philipp's brain kind of processes the menu of being an economist?
Obviously, we run models too. We're quantitative, we're analytically driven, but we typically take a historical first stab at most topics, not because history repeats itself, but because it tells you how the system is constructed, and knowing how the system operates is really invaluable. I'm not an engineer, but if you ask me to assess the viability of a bridge that I'm driving over, I'd probably ask you, well, how was it constructed? Like, what went into the bridge? And in the same way, most macro topics, I want to know everything I can about how did the system come into place? What is the construction institutionally, the governance around it, what kind of stress moments did we have in the past. So a ton of work we do is historical, not in a deterministic way, but in a contextualizing way. And the book is chock full of long-run charts. So that's something we do. We do a lot of financial markets cross-checks. We leverage a lot of financial market data. So my own history as well, working on the sell side, as you mentioned at the beginning. So public markets are a very, very profound source of very good data and cross-checks and often in quasi-real time, important information. We often like to ask questions such as, what would it take for a particular outcome to occur? Often in the doomsaying slants, people are jumping straight to the edge of the risk distribution. They say, oh, this black swan thing can happen and will happen, and this is how bad it's going to be. We'll like to pace the analysis typically with pretty stringent questions of, well, what does it take for the risk at the edge of the distribution to move to the center and become a base case? And when you discipline yourself with such questions, you typically find out the bar is pretty high. There are multiple bars to clear. A confluence of pretty bad things has to unfold for that to happen particularly rapidly. And so, these are just three examples of how we like to do stuff. And when I say we, I'm my co-author and myself, so Paul Swartz and myself, we've been working a long time together, and we've developed sort of these analytical approaches that I just touched on.
We're going to get deep in the book in a minute, but there's an older piece you wrote that I love, and I thought we'd talk about because, as you mentioned, everyone over the last year or two, like the big word has been recession. Like, are we going to be in a recession? Are we not going to be in a recession? Yada, yada. And you had a fun recession risk kind of article talking about mortality from infections and heart disease and penicillin and cancer. Tell us a little bit about what that paper was about.
I'm glad you spotted it somewhere. It's pretty old, this piece. It was, I think, 2017 or 18, maybe 2018. So
in my head, that's like last year. And then I have to do the math. I'm like, wait a minute, that's like 8 years ago. How's that possible?
Back then, and still now, and the book too has it, we like to think in terms of a recession risk framework where the starting point is a recognition that recessions are not at all homogeneous, but they typically fall into three groups. The real economy recessions, there are policy errors, and then there are financial system driven recessions. And these three types, they change over time, but sort of in a 10-year space, they're pretty consistent. And they come with very different downsides, so they're not equally bad. The financial system recession would be sort of the worst type of recession you could have. Think 2008. A lot of real economy recessions are pretty shallow, by and large. And so we like this risk type and recession type framework. It's served us well over the years. And cancer and stroke and heart disease analogy, it comes from an attempt to make this a little more accessible to people who don't think about this nonstop, right? And we're basically look at the history of human mortality, where once upon a time, infections was what you died of. I mean, your susceptibility to infections was very, very high. And so your mortality share of cancer and heart disease was actually very low because most people just died of infections. Then comes along penicillin. It brings down the rate of death stemming from infections, but it pushes up the share, or the market share, if you will, of cancer and of heart disease in the mortality distribution. And so essentially, you get a shift in the risk profile. The human longevity risk profile shifts toward heart disease and cancer as we conquer infections. And we use that analogy to make similar points about real recessions versus policy error recessions versus financial recessions. Real recessions used to be very common, like infections that kill people. The weather used to give you a real economy recession 100 whatever years ago because it was an agrarian economy. Well, now you don't see real economy recessions that often. That in the middle of the last century, it was a lot about policy error recessions because monetary policy was on a learning curve and climbed that learning curve. And so the risk profile shifted over time into financial recessions, which are, I'm not saying that they're very frequent, but if and when they hit, they're particularly pernicious. And so, this is the story with the human health profile or death profile versus recessions.
And so you got to ask, I'm sure you get tired of this. Like, there's questions that I get all the time where you just like, oh my gosh, like, are we still talking about this? And I imagine as an economist, all your meetings, if someone comes to you and says, Philip, well, are we going to go in a recession? Where are we? What's happening? Is that like the number one question you get all the time? I feel like it asked, but I have to ask it now. You led yourself into it. So are we going heart attack or infection here in 2025?
Let's first of all acknowledge that recession risk is really elevated now relative to where we were at the beginning of the year. There's no doubt about it. So even though I'm an optimist and the book calls out a lot of doomsaying slants in public discourse, there's little doubt that the macroeconomic cyclical picture has darkened a lot. And obviously tariffs are the biggest part of that. That said, recently you got a lot of headlines and a lot of public debate around, we're going to have a recession by the summer. And countless headlines written. And I think that is probably one of those exact newsy, clickbaity things that are said and written about. Just think about it. It's the beginning of May, essentially. And by the summer means June or July. Well, let's call it July. So you have May and June, 2 months left for essentially the labor market to collapse. A recession is a labor market event. Don't forget that. Soft data does not make a recession. So you're going to need to see a May and June print of non-farm payrolls that is in free fall. You're going to need to see mass layoffs over the next 60, 70, 80 days for this to become a reality. And while it's possible, I don't know why people make that their base case, other than having a flashy prediction that people find very quotable. So I don't think there is any guarantee at all of a recession by the summer. In fact, the labor market's pretty robust. We're starting from a position of strength. Households are actually in a pretty strong position as a starting point. Now, there are a lot of headwinds. All of this is decaying, and I think tariffs really don't help. But that shouldn't lead us to an extrapolation to say, well, the recession is just the next stop on the subway. It's a little more complex than that. And so if you get a recession, it's plausible, it's possible, but I push it further out on the timeline. It takes longer for the system, the cyclical picture to decay. And so, I'm glad we got it out of the way, the little recession talk. It's certainly elevated risk. It's not a done deal.
Is there another least favorite question that you get? Because I feel like we can avoid it. It's like talking about pet peeves. Like, you ask people what their favorite pet peeve is, And it's like you get the most animated responses. Like, and you're a New Yorker, and so people getting in the elevator before you get out is like the funniest thing to me ever. It's like, what do you think's happening here? Anyway, sorry.
Fair point. I mean, look, another perennial question and worry, and particularly now, is public debt. I don't know if that's something you want to touch on.
Let's talk about it. What do you think?
It's one of those perennial questions where the assumption is the amount of debt is just so high. It's like we're just an inch away from falling to our economic death because debt is a huge problem. And I don't want to downplay it in the sense that like it doesn't matter. It does matter. It is a lot of debt. But the way we're framing public debt in public discourse is exclusively counting the dollars, the amount of debt, either in trillion-dollar space or in debt to GDP space. Right? These are the two ways we're talking about debt. Is that really meaningful? I don't think so. And the book argues we should take a different lens analyzing debt. It is really about the relationship between the nominal growth rate in the economy that allows you to service the debt and the nominal interest rate that you pay on the debt. And when these are structurally with a gap where growth runs ahead of interest rates, well, then honestly, whether you have X or Y amount of debt is not critical. The critical point is the spread between nominal growth and nominal interest rates. That is not to trivialize that we have a lot of debt and that we should rein it in and we should pay some of it down and all that. But countless headlines are written every month about how many $1 trillion in debt we have. It tells you very little about risk. What tells you about risk is if the 10-year yield rises persistently above the level of our nominal GDP growth, that's what would get me worried. But the incremental $10 billion of public debt is not a metric that I watch to assess the risk of sovereign debt in the US.
There's always two things that I think about anytime someone brings this up. The first being that debt is also someone's asset. So grandma's clipping a 4% coupon or whatever it may be. But the bigger one, and I've seen this a few times, but I love to see the balance sheet of the United States. Nobody's like, here's our debt, but also here's our assets. Here's what this looks relative, which is always interesting to me to see kind of that comparison. It puts things a little bit into perspective because everyone always wants to assume that debt is very similar to our own personal debt. And it's not how it works. But it gets confusing for, I think, a lot of people.
Yeah, I mean, part of it, of course, is held elsewhere. So the creditors, if you will, they're outside of the US in part. But by and large, I agree with you. Yeah.
Maybe in the future, we just start doing a pardon the interruption style show, listeners, where we just like ask our guests, like, what's the most triggering question you consistently get? And then just start the episode there because I got so many. All right, let's talk about some more book stuff. All right, number 2 topic of 2025. I mean, I imagine as an economist 10 years ago, 15 years ago, if you're like, hey, let's teleport back to the future style, take the DeLorean to 2025. You know what the number one thing you're going to be talking about is tariffs. You'd be like, no way. Talk to us a little bit about like, how do you even wrap your hands around that topic? People like Bridgewater off of the debt, you know, they're like, this is a generation economic shift. Are tariffs, is there a way to even handicap like how to think about this and kind of how do you think about it with your economist hat on?
Yeah, it is a big inflection in the system. I think it is one of those structural shifts. It doesn't happen sort of abruptly like a coronavirus lands in terms of visibility and impact. It's going to be slower moving, but it certainly is an inflection. Even if you dial back a lot of the tariff announcements and attitude, et cetera, you know, getting the toothpaste back into the tube is basically not possible. So something's changed in this. And what this speaks to is what we in the book call good macro, almost like the operating system in the global macro space. Good macro is sort of a term of art, which we use as a catch-all to describe a very benign operating system that certainly describes the real economy. You had sort of ever longer cycles. You had sort of the great moderation on the real economy side. On the financial side, you had inflation coming down structurally, pulling down interest rates with it, which gave you sort of a valuation upshift. And then in the international domain, you had those sprawling global value chains. So coming to your trade topic, essentially we baked trade and global value chains into the operating system, and it became an assumption that it works that way and it works in one direction and that is something reliable. And now it's not. And this is exactly one of those structural shifts that can happen, but don't happen very often. They don't announce themselves very easily, and they are a matter of degree, not kind. So part of the reason why we're in this moment of dislocation this year is because there are many different ways of doing a trade war. You could have done it in a very narrow way, which is how it often looked it would be, something with China, a little bit with German car makers, etc. But then suddenly it's a 360-degree trade war where the US is in a trade war with absolutely every other nation. And those are these shocks to the assumptions of how the operating system works. These are these, genuine moments of inflection. I didn't see this coming, certainly not, but it's something where analytically we need to be nimble enough to react and respond to it.
I think talking about that sort of probabilistic view of the future with so much, we're recording this on a Fed day, of course, so many different outcomes can be both exciting and maddening, I feel like, at the same time, for not just business owners. And you see all these weird sentiment confidence surveys and studies, and despite markets having returned amazing amounts the past 15 years, like sentiment very dour in certain areas. How do you guys kind of think about the squishier side of economics? The people, the behavioral side, the sentiment side, so the tariffs are one thing and the mathematic side to it, but also we're all humans, and what we decide to do on a daily basis certainly is an input to the system. How do you think about that topic?
Yeah, it matters a great deal, and it's tough to handle analytically. Case in point, just think about consumer sentiment. It has wrong-footed so many analysts, so many economists the last few years. Consumer sentiment, the way it's captured by surveys like the Michigan survey, was down. It was down with COVID. It never really recovered. It was down and volatile, and it was on a downtrend. And that really fed into the recession narrative in 22 and 23 and 24. But if you put consumer sentiment next to real spending, just total consumption in the US, there's like two curves that just go apart. There's a complete wedge between them. Because consumers tell survey makers one thing, and then they turned around and did a completely different thing, which was consume, consume, consume. To your question, yes, obviously it matters a great deal. What can you do about it? There's limits, but one thing was to ask, well, is what consumers say the same thing as what they do? It seems simple enough to assume that what they say is what they do, but the reality just wasn't that. And so we, in 2022, we did an op-ed, I think it was in Fortune at the time. We said, or even at the end of 21, we said, don't watch what consumers say, watch what they do. Just look at the evidence. It's going to be lagging, right? It's not real-time data because the consumption data is going to be lagging somewhat. But that's a better handicap than taking at face value what the survey results are going to tell you. Now, this little story I just told you about consumer confidence, it held all the way through the tariff announcement. And from here, consumer sentiment is going to take a further hit. You're going to see that in a further decay in consumer sentiment. I'm not saying it never matters. It will matter, I think, now. You're going to see a lot of uncertainty in consumers' heads, and that will feed through to some of their spending behavior. But to your point, and what I mentioned earlier, economics isn't a science from the way it's constructed, from the variables that we deal with in economics, the persistence and the permanence of variables and their constellation. But, and I hadn't mentioned that yet, and so it's good that you bring it up, it's also the people we're studying. Well, they're humans, and they're not molecules and particles. And so a lot of this has found its way into microeconomic analysis, behavioral economics, more of a micro story. But it feeds through to macro too. And so I think the consumer sentiment example hopefully is a good way of illustrating that. You could get a lot of things wrong the last 3 years by watching consumer sentiment, and plenty of people did get a lot of stuff wrong by watching consumer sentiment.
Sentiment's always fun for me to watch, but it's more of a magazine cover indicator for me. I like to read it. I'm take note of it, but I don't know that I would ever put any real big moolah on it, because there's cultural differences too. I had a buddy once who, there was a business model in Australia and I think Canada where consumers would save up over the course of the year for something like Thanksgiving or Christmas. And I forget what it was called, but they would basically put money on, not layaway, but save it per month. And then by the time Thanksgiving or Christmas came around, they had a bunch of money to spend it. And he's like, I'm going to roll this out in America. And I'm like, you don't understand. Like, that's not how Americans behave. Like, they'll just wait till Thanksgiving and put it all on their credit card. I'm like, have you met an American? Like, no one's thinking a year ahead of time. Like, that's the most nonsensical.
Yeah, it's pretty unique about American consumers, by the way. I mean, Europeans don't really consume unless they have the money in the bank for a particular item of consumption. Obviously, the exception is housing, real estate, and perhaps cars. But even car loans are far less common in Europe than they're here. And certainly kind of discretionary consumption is frowned upon to be done on leverage in Europe in many social circles. It's a very unique American thing, as you point out, with the contrast to Australia. I would add Europe. I know less about Latin America in that regard, but Europe certainly backs up your case.
But there's an interesting kind of spread too, and I don't know if it's just in the risk-taking nature of our culture, but investing, you see a lot less investors in traditional stock markets ignoring pensions, but personally in places like Germany, it always surprises me to see how few of my friends over in Europe and elsewhere actually invest. It's either in safe or short-term bonds, or the big one's always real estate. But you talk to most people about, hey, do you have a stock portfolio? And the answer is often, it's very few.
Yeah, there's a lot of risk aversion there. And I think it is one of the drivers why you see the growing wealth gap between Western Europe and North America. 20 years ago, that wealth gap probably was there, incipient, but now it's very visible. You can't talk it away. You can try to sort of talk it away around the edges in terms of, living standards and provision of certain services that are market-based here and kind of baked into their system in Europe. But even with that, part of this, what you're saying, is balance sheets have run up quite high in the US. That's partly because of investment in public markets, public equities. They've done well. The US has outperformed over that time frame that I just referenced. And all of that, I think, it shows up in a wealth advantage that is quite sizable at this point for the average household.
This is always complicated for me because there's one of my favorite indicators. I don't know if it's indicator, but it's chart, is the percentage of household wealth in stocks. And it tracks just the stock market in general. So 1982 was like 10%. And, now it's multiples higher. And traditionally, it's been a really good inverse indicator to say future returns on the stock market. But a lot of that is just, what has the performance done? So it's always conflicted to me because I think every American should own stocks. I want to see that number at 100% of households having investments and a lot in stocks. But at the same time, on a sentiment kind of indicator level, it tends to be a contrary one. Do you have a favorite? Someone says, Philip, all right, feet to the fire. Do you have a favorite economic indicator report, study, something that you're like, oh, this is one of the good ones?
Not really. And it's really this aversion to dashboard economics that I described at the beginning of the conversation. I didn't use that term yet, but a lot of economics coverage is sort of dashboardy. The idea is, I'm like a pilot and I have sophisticated screens and then the dashboard is going to have a blinking light and that tells me do this or that. It just never really works like that. And this is why we're bad at forecasting recessions and acting on it. And so all of this is idiosyncratic. You had, a dozen recessions since World War II in the United States. Each recession is totally idiosyncratic, had its own drivers, own context, own constellation. The idea that you could somehow redux that into a dashboardy, blinking light that tells you, oh, and now is recession number 13 or whatever it is. I think it would be 13 at this point. It's just not really how these things play out. Back to the eclecticism thing that I mentioned, the master model mentality. So I don't have like a single thing that I follow. I certainly find a lot of things interesting. And to your point, what you just said about stocks, I mean, when stocks are as richly valued as they are today, they've come off their highs a little bit now because of the tariff gyrations. Even as the market has bounced back and is basically back to April 2nd levels, the valuations are a nudge lower now. You could easily make the case, do you really want to buy into that stock market from a wealth building perspective for somebody who starts out in investing and accumulating? Is that the right move? You probably want to go to markets that are more cheaply priced and valued.
Man after my own heart. Amen, brother. We talk a lot about global investing. I feel like you talk to a lot of CEOs, but just talking to people in general, the development of AI, you're seeing it, the tentacles really start to make its way through everyday life of everyone on not just memes on Twitter, but very real implications. I always feel like the Economist, particularly when it involves markets, biggest fear is always inflation or PTSD from something like the 70s. Like we just can't have something like that again. And then you have all these developments with AI and tech. How do you think about these sort of competing forces, and as people are trying to plan for the future, but also develop policy when it comes to things like the price of food, but also you have tech and AI forces being deflationary? How do you think about that?
We talk about this in the book quite a bit. And let me start at the top level. Let's say you have a tight labor market the way we have it. And by the way, it's a structural thing. It's not a cyclical thing. The labor market was tight already pre-COVID. It turned tight in 2017 under Trump first administration. COVID was an interruption with unemployment spiking, and then it went straight back to tightness. So it feels a lot more like a multi-cycle structural tightness that we have already. If you can really bring automation, AI into the services industry to lower the demand for labor, that is kind of the Goldilocks scenario for this, because the tightness will persist, cyclical setbacks notwithstanding. We're shifting the conversation right now to a more thematic, structural, strategic horizon, right? So over multiple cycles, you'll have that structural tightness. And if you can get AI to do some of the work for which there isn't enough labor, that's a Goldilocks thing. And I think there certainly is the prospect of this. And we've seen an uptick in productivity growth. It's just the idea that AI is this switch that we just need to, flip on, and then you get this step change in growth, and productivity growth goes up 100 basis points and GDP goes up. That's not really how this plays out and how it works out. It's just very gradual, incremental. There are a lot of hurdles, a lot of obstacles. People have to tweak this until they find it works. There are going to be a lot of setbacks. So all of this accumulates pretty slowly. And I think about it more as a 10-year frame to see like material, visible GDP level impact of these things. And until then, you have very incremental things, all here, all there, but nothing that you see at the top line too easily. So I believe there is a tailwind from AI and tech in that regard. I just think it plays out a little more slowly and with a few setbacks in between. And then about the deflationary nature of technologies is really important to keep that in mind. Over the long run, tech is deflationary. Innovation is deflationary. Like once upon a time, half of America worked on a farm, and we spent 45% of our income on food. And then you had multiple waves of technology that left only 2% of people or less working in agriculture. And what do you spend on food? The average American spends 12, 13% of their income on food. So you had this gain, having spent 45% on food and now only 12 or 13%, the savings went into, that's the deflationary effect of tech over the long run. And the savings, they were plowed back into everything else. Goods, predominantly services over the last few decades. And I think this mechanism, this deflationary nature of tech, it will continue in the structural sense, not cycle within the cycle, but over many cycles that persists. And that's what also keeps the labor market, I think, not totally immune to tech. But the idea that you have mass unemployment because of tech, I don't think so. It's more like you're going to see these deflationary income boosts, and that will allow people to buy new services, and that will create new employment. So all the people who worked in agriculture, they're not unemployed today. They work in anything from tourism and yoga instructors to a lot of financial services, other jobs, academia, food services, you name it, right? So there's going to be a repurposing of labor that comes with that. And so this is how I think about it, and this is how the book talks about the deflationary nature of tech as well.
Two of the things we haven't really spent too much time on today, but I feel like are topical. One is the shiny metal. I feel like all the economists I know have very, very different opinions on gold in general, but also a somewhat related topic being the dollar, which has been in a bit of a downdraft lately relative to a lot of currencies, but you have all sorts of cross currents with currencies. You got the Taiwanese dollar going a little nutty and who knows what. Any general thoughts on either of those topics? Pick, choose, one, both?
Yeah, let's talk a bit about the dollar first. So just very, very tactically the last few weeks, I think the fact that you saw the dollar lose in value, the fact that it decoupled from interest rate differentials, that is significant. I mentioned in the beginning, a lot of asset prices have gone back to their April 2nd levels. So we've clawed our way back in equity markets. You see it in high yield spreads. You see it in other markets, asset markets, not the dollar and not gold. And that is a reminder that all these tariff gyrations, they do seem to undermine the credibility, the institutional credibility of the US as the benign orchestrator of the global system. And this is sort of intangible stuff, right? There's no price for that. There's no market for that credibility, but there is in a way in terms of, well, what's the price of gold and what's the price of the dollar? And we're seeing these intangibles show up in those assets, if you will. And the fact that they haven't bounced back, I think, should be a big warning sign and a big shock, if you will, to those orchestrating those policy changes, investors globally and locally. They have genuine institutional fears about that, right? And so that's where I'm willing to say there's something here that is worth watching and worth being worried about. That said, the story of dollar death is decades old. Ever since you had the dollar shock under Nixon, taking the dollar off gold, or essentially ending the dollar peg for good in 71, there have been countless obituaries that were written about the death of the dollar. And in fact, the book has a whole chapter on just the perennial dollar obituaries. I think even if you get an undermining of the dollar and it's already underway, as the data would suggest, something's happening there. It's a slow moving thing with a lot of potential for course correction. There isn't an alternative for this. Being the reserve currency in public discourse is often only cast as this, enormous, exorbitant privilege. It's also a burden. Operating an open capital account, China isn't willing to do it. Otherwise, they would do it. And you see how the euro hasn't really stepped up to the role of reserve currency, a big one. Why? There's a lot of burden that comes with it. You lose control over flows, and the rest of the world saves in your currency. And that leads exactly to the kind of imbalances, which in the end, they also lead to those trade deficits that we're talking about. I'm more on the side of global imbalances really are an expression not of America living beyond its means and borrowing too much. It's more like global savings are dumped in America because surplus countries are taking their export earnings and they're putting it in treasuries, they're putting it in condos and wherever in Miami and California, and they're putting in all these US denominated assets. And that money has to be recycled, and that in the end goes into consumption, and that goes into imports into the US. And so I think all that is not something that many currencies can and want to shoulder as a burden. And so is there an alternative to the dollar? No, there isn't. And if we're undermining it, it's a matter of degree currently. It's not a binary 1-0 thing. So I think there is some room here to course correct.
Yeah. As we look out to the rest of 2025, out into the horizon on 2026, so what's on your brain that if there's anything we haven't talked about that you're excited about, confused about, angry about, or you're just mulling over, working on that you think is interesting, exciting, is there anything that comes to mind?
Yeah, for sure. I think obviously the elephant in the room is how you're going to resolve the tariff standoff. It can't persist like that. You can't write forward 145 tariff rate on China. It's, basically trade doesn't function at those levels.
I don't know, man. You say it can't persist. Who knows with this
it can, but you're not going to have trade volumes at those levels, right? It can, absolutely. But, trade's going to go down, 80% at those levels? And it's in neither side's interest to do this, right? So I think something will have to happen. Whoever moves first, it's obviously complex, but I think what I'm watching for is signs of new instruments to do this trade relationship dimension. We all think of these big treaties like USMCA. It's a big treaty, but maybe we're going to move to something that is a little more flexible, more like, agreements and memoranda of understanding, and leaving a little more open, and you kind of basically pause it indefinitely and see how it goes. And a lot of people say you can't do these trade deals in such a short period of time. Well, that's on the assumption that we're talking about these carved in stone, big monumental trade deals. Well, maybe you can do something that's a lot more flexible and a little more superficial, and maybe you can do something and you will do something. I think something has to happen, and I believe we'll see more movement on that side. And I think a lot of that expectation is baked into asset prices that have actually bounced back quite a bit since April 2nd. So I think that is something I watch out for on the hopeful side to sort of tactically resolve a lot of the stress. I think on the negative side or side of peril, you saw the market reaction to questioning the independence of the Fed. It's an old topic. It's an evergreen. It's not like a new topic. The Fed has always been a little under pressure, varying degrees, but under most presidencies, not all, but under many presidencies in the past, you had some leaning on the Fed. I think, most of that is probably behind us, and there's a lot of signaling that the Fed is not in the crosshairs of the administration, but just as a reminder of how powerful it is and how impactful it is, rather, to question those institutional foundations, I think it's these types of things, the what I called intangible stuff earlier, right? Like how the system is constructed, how the institutions are defined. That's something that I watch carefully on the side of peril.
Where do people go to find more of your writing info? Can they consume it on a regular basis? And if so, what's the best place?
So I have two products, research products. One is really intended for clients. It's more technical, but we put a lot of people on the distribution. So under BCG, people can sign up, and it's sort of manually looked into where do people work, what do they use it for, but it's a fairly broad distribution. And then we have a public product that consists of articles and op-eds. So I, together with my co-author, quite often publish in Fortune, Harvard Business Review, World Economic Forum, these sort of more business-oriented publications, more targeted at executives. But it's those two channels. And then, of course, there's the book that I mentioned. And I'm on a few podcasts like yours. So that is an increasingly big dissemination channel that has really taken off over the last few years. And I think it's excellent. And it's very valuable to have these conversations accessible to many more people. So that's a good thing.
Well, listeners, pick up his book, Shocks, Crises, False Alarms, How to Assess True Macroeconomic Risk. It's a mouthful.
It is.
Philipp Carlsson. Philipp, thanks so much for joining us today.
Thank you for having me. My pleasure.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.